Welcome back to Vantage. There's been a lot of headlines in the press about ARM listing in the US, about CRH opting to list in the US, and some concerns about the health of our stock market. At a time where this is being questioned, I'm delighted to get someone on who's got some strong views about that. He's also a champion of the UK listed company. Let's go take a look. Welcome back to Vantage. We have a guest who has been on the show many times before. Delighted to get Gervais back on to talk to us. Gervais, welcome back. For those who don't know you, maybe you can tell us just a little bit about yourself, the funds you manage, and your role at Premier.
I'm a UK fund manager. I've been investing in the UK markets really for over 3 decades now, so a bit of an experience there. Particularly focus on a multi-cap approach, so particularly invested in some of the smaller quoted companies, AIM-listed companies, also many mainstream companies as well. And the funds I run at Premier Miton are Diverse Income Trust, which is an income fund, as suggested, and the principal objective is to grow its income hopefully better than most others, and that will drag share prices up over time and hopefully deliver a nice long-term return. And alongside that, the microcap trust, so the Miton UK microcap trust, which invests not just in small companies, but what are called microcaps, which might sound to me and you like corner shops. They're not. They're mainstream companies. They're just microcaps versus Shell, which is a mega cap.
Okay. And let's get into a little bit more detail on the funds. Rough size, number of holdings. I think you've covered off the investment objectives, but I'd love to hear a little bit more about the dividend history of Divi in particular.
Yeah, so the main objective of the Diverse Income Trust is to generate good and growing income. During the years when things are going well, hopefully you can save a bit of income for difficult times. They're called reserves. We did have an unsettled period in the year to May 2020. The trust has a May year end. Obviously there were quite a lot of dividend cuts around the pandemic. Fortunately, the fund itself, whilst it had revenue downturn that year, the reserves were there. The board could see the recovery coming through even at the time they announced the final dividend. So they didn't just maintain the dividend, they actually increased it, using, of course, in part the reserves. And subsequently, it's grown further with further dividend increases. So most particularly, it's got a very sort of attractive long-term period of growth of dividends. And actually, if anything, if we can just keep that going forward, we think that will drag share prices up, because the actual share prices have been a bit disappointing the last 12 months, particularly, not just due to the setback last year, but also because actually UK equities are out of fashion. And so UK microcaps and small caps are most particularly out of fashion at the moment.
Yeah, we'll come on to that. And then just in terms of how many holdings do you typically have in the funds? I mean, is it 50, 100? What do you...
Yeah, it's traditional for a lot of funds to have perhaps the best 30 ideas or the best 50 ideas. It's quite common. This fund has 120, 130 holdings. So again, it looks as though we can't make our mind up. It's just not anything like that. We want to be able to invest right the way across the market, including, as I say, some of the AIM equity income stocks, as well as some of the mainstream stocks. And some of those companies are just smaller. And if we suddenly just had 30 or 50, we wouldn't be able to invest in some of these immature companies with different market sectors, which actually can often sustain growth even at times of global recessions. And so it's a much more wide-ranging fund. That's why it's called diverse. The actual sort of individual contributions toward income come from lots of little holdings rather than just one or two big ones. So if things change, you don't get caught out in quite the same way. But most particularly, it's the wide-ranging number of holdings, and that's the same with the microcap trust. Again, about 130 holdings.
Now, you're on record of saying that you're the most bullish you've been for 30 years. Now, I would love to understand what is driving that. Maybe you can tell us what you see on the horizon that's making investing so attractive for you right now.
I think one of the features of the UK market specifically is that it's very lowly valued versus international markets. If you take price to book, which is a measure of how many assets you get for your share prices, it's standing at approximately a third of the valuation of the, say, the S&P 500 in the US. So that's an extraordinarily large differential in valuation, right? So the question is, why should it change? If it's been there and nothing's happened in the last few years, why should it change? And that's because globalization is coming to an end. We would argue the last 30 years have been defined by the growth of globalization. That's been a feature which actually very much favored more speculative companies, more companies which have more volatile share prices, sometimes unicorns which are making losses now to generate profits in the future. All of those companies are largely dominated by US listings, particularly in the US stock market, and NASDAQ in particular has been sensational over the last 30 years. And that's really drawn in capital from international markets, but particularly from UK, where we've seen a reduction in allocations, not just pension funds. Many other clients have actually reduced the UK, and we've got to a stage now where most people aren't very heavily weighted in the UK, the valuations are very low, and globalization's coming towards an end in our view, and that change of pattern we think will not just lead people to start stopping selling in the UK, which I think is a good start in itself, but actually we'll see new allocations to the UK, and I think that will drive valuations back up. That valuation differential will start to get closed. So I think the UK stock market will outperform most international stock markets over the next 20 years.
Okay. Now let's pick up on that and expand on it in a little bit more detail. So I mean, to a certain extent, since Brexit, we continue to see outflows out of the UK equity market, and there seems to be progress on that front with the Windsor agreement. And at the same time, the last week's headlines were all about other companies going to list in the US over the UK, and I particularly, I mean, if I date you correctly, you would have started your career at the point of Big Bang, effectively. So
a few years before, but yes. Yeah.
So I mean, I'd love to get a perspective from you in terms of what is going to make the UK attractive again, partly from the inflows. And I think you've started building on that argument that it's old school economy companies that are going to start to sort of gain people's attention in a difficult world. But also, what's going to make the UK a place where you're going to get the new stock of vibrant companies listing, etc., which is what you want, right?
Absolutely. So coming back to it, I think the nature of the UK, the culture of the UK market is different from many other international markets. We've always had an emphasis towards companies which invest now to generate a stream of income going forward. So these are often capital intensive businesses. Now when capital's for free, a capital-intensive business has no real advantage. Suddenly the oil price goes to 150 and then there's lots of new oil fields all around the world, right? Because capital's for free. Now that interest rates have gone up, with inflation, ultimately capital starts to cost money. So actually capital-intensive businesses start to make not just return, but more sustained return. But the better thing about income is not just that, it's nice to get a good income, it grows over time, but even if stock markets don't go up, and let's be honest, after globalization, valuations across the global asset markets, and I'm not just talking about bonds and equities, but property and other things, are very elevated prices at the moment. So the valuations might reduce anyway going forward because of inflation. And actually, profit margins, particularly US profit margins, have touched 18, nearly 20% in the last year or two. Right? Through the cycle last time, they're more like 12, and actually at the bottom of the 75 and sort of 80s, it was down to 8%. So I think we're going to get a profits recession. So for that reason, I think ultimately stock markets don't go up. Right? So there's quite a good chance that you can invest in a mainstream index fund, perhaps a S&P 500, and it won't get a return beyond inflation. And that's very disappointing. Well, the great advantage of income, not only do you get your income, it doesn't matter if the market goes up or not, but as the income grows with inflation, then of course you compound, you can buy more shares and the income gets bigger and bigger, and then you generate a nice return in that way. And that's where the UK is, and I think that'll be a bigger part of global portfolios, a bigger part of UK portfolios going forward.
Okay, interesting. Now, given your outlook, I'd be, and particularly, how you're looking at the market as a particularly attractive, love to understand if you've had any kind of tilt in view in terms of where you're allocating capital, and large cap versus small cap or particular sectors. Has there been any shift in where you're positioning yourself or particular sectors that you're interested in over the last 12 months?
Not interestingly, not much actually. The shift is anything. We do bring new portfolio holdings in, but if anything, we're just buying more of our existing holdings at the moment because the valuations are very overlooked. Many of these companies are continuing to thrive. Most particularly, we're looking for companies which actually are generating abnormally significant amounts of surplus cash in the next 2 or 3 years. That gives them the resilience, even if markets are unsettled, to continue to pay dividends, to grow their dividends at a time when others. Ultimately, if we do get quite a lot of companies going bust, which I fear there might be quite a lot of zombie kind companies, maybe some of the highly borrowed private companies will start to go bust, then you can keep the teams together by acquiring the asset from the receiver, debt-free, for a knockdown price, and make extra return. I mean, you will have seen Made.com came to market a few years ago, 700 million market cap or whatever it got to, obviously a loss-making company. Even with the issue, it went bust, and Next bought it for 3.4 million. Right?
I know, a great example.
Probably need to just emphasise that probably needed to put in 25 million of working capital. I don't know what the number is, I'm guessing this number. So the probably total valuation was probably 30 million, and it probably was never worth 700 million. Say it was worth 300 million, but buying a 300 million pound company for 30 million is good business. Absolutely. And most particularly, even Next, which is a 7 billion pound company, that's an extra 4% in dividends and income going forward.
So let's expand or illustrate that in a little bit more detail. So I was going to ask you, give me a couple of examples of new things that you bought, but I'd change the question to anything new that's entered the portfolio, or anything that you've added, more sort of capital to from the existing holdings, and the rationale behind it.
So there's quite a lot of mainstream companies which are lowly valued. So, but particularly the most overvalued, we'd argue, are further down the market cap range, often on the AIM-listed market, generating good income, good and growing income. But most particularly, the things we're worried about at the moment is we're going to get margin pressure, a profits recession coming forward. And if there's a profits recession, you need companies which can really hold on to profits. And they need to do that by delivering not good but outstanding levels of service. So we do engage with a lot of companies. So perhaps a company we've topped up is something like XPS Pensions. It's a pension advisory company. It's involved in helping pension funds particularly navigate this very unsettled period of uncertainty about all the bond market movements and that's right, then the LDI, all the rest of it. So interestingly, it's an outstanding customer service company, right? And how can I be so certain about that? They've just had the National Actuaries Awards. I don't think that's the exact term. I don't know what the magazine's called, but anyway, they just won the best 3 awards for the first time in that magazine's history since it ever started the awards. So there we are. So there's a good company, good and growing income, overlooked valuation, but most particularly, again, a relatively strong balance sheet. You've got to be really careful that you haven't got businesses which are hopefully okay, but if they see any downturn in trading, their balance sheet means that they have to cut dividends or indeed have to go for emergency fundraising at a very low level like the banks did in 2008 and dilute all of future returns. So that kind of company is absolutely the opportunity, and the share price has hardly moved. It's moved up a little bit this year, but it's hardly moved. And so more of those right the way across the portfolio is just the right thing to be buying at the moment.
And is that something that you've known for a long period of time, or is it something more?
Yeah, it's interesting. It came to market in 2017. It was quite a good company. It came at quite a high valuation. It had a very good history, and actually it made an acquisition of the Punter Southall business, which was quite a good acquisition, but it didn't produce the returns as quickly expected. And so actually within a year or two, the share price was completely derated because the returns weren't coming as fast as investors thought. And so the share price, compared to where it was, is lower. The scale of the operation is probably 3 times the size. And most particularly, the opportunity for taking market share going forward is particularly strong at the moment, given all these changes in the market. So all of that suggests that actually you're getting in a low valuation in a business which has more resilience and more dividend income growth than most others, at a time when there's lots of other companies around the world which are very, very expensive at the moment.
Okay, and maybe reflect back on the last year, and when you're looking at the portfolio, of something that's been an outstanding contributor to performance. And also, I'm always interested in how you deal with the other side of something that hasn't quite performed to expectations. So maybe talk about a couple of examples that, within the portfolio that illustrate that.
Yeah, so the kind of things which we invest in are obviously companies which are going to not just do well but get better prospects going forward. And actually we think active fund management is going to become a lot more important. So actually the current largest portfolio holding is a company called Man Group. You probably know it. It's an active fund management group, an alpha shop. It's an unusual house, not just that it generates actually very good returns for its clients, and that's going to be more important at a time when there's not many returns around. It manages downside risk really well. That's another feature. But actually, because of its client base, it can actually charge performance-related funds as well, performance-related fees. So it gets extra fees on top. So it generates not just good returns. It's not just continue to win clients, but most particularly, it's generated quite a lot of performance-related fees. So the income has come through really strong, and the share prices perform very strongly. So that's on the plus side, right? On the negative side, we had 888, which is something involved in gaming. It helps people if you want to go online and game on sort of sports or whatever. Unfortunately, we understood, because they have their own technology, that they were able to look after problem gamblers better than most others. It hasn't actually achieved that. When you see some of the recent results, they haven't looked after problem gamblers as well as we expect. Now, that's not only meant that actually because they were taking over William Hill, it was not, that sort of increased the risk in terms of the balance sheet. But actually, with that, it was another reason to sell it. So that's a company which hasn't performed so well, and we have sold for those reasons.
Okay, interesting. And I mean, if you, I'm sure you meet plenty of companies.
Loads. We probably meet more companies than most other fund managers you meet, actually. We do meetings all day, nearly every day, with companies.
I guess the final thing I wanted to ask you is that, what's the one piece of advice you'd give to management, particularly when they're concerned about where their valuation. And I'm talking, I know the old adage is, look, focus on the business and don't worry about the share price. But I do get that sense of there's a lot of people who are trying to get their business right for a changing world, who are very concerned about the fact that actually all this work, someone is going to swoop in and take the business out from underneath their feet. What advice do you give them?
Well, I think it's important because actually we are seeing quite a lot of companies beginning to think that actually the valuations overseas are higher than the valuations in the UK. Yeah. And we saw CRH this last week, and there's a few others which ARM didn't come to list in the UK. Yeah. So from that point of view, that differential in valuations means that actually people can add share price quite quickly by delisting and making their primary listing overseas, which is very disappointing as a starting point, right?
Yeah, yeah.
And if we don't see perhaps a bigger change in terms of political interest in this subject, I think the triple could much more of a stream going forward. Now, in the very short term, CRH share price has gone up on the announcement, and if other companies delist, they'll go up. That probably boosts the UK index in the very short term, but it means actually that the UK's relevance as a stock market around the world becomes less relevant in the future. So we've got to be worried about that. But the key feature about the UK market, and the reason what I would highlight to management teams is, for the last 30 years, actually, it's not been very good to be listed. You'd be better off highly geared in some kind of private equity structure, where all the debt gets more cheaper and cheaper, and the valuations get up and up and up, and you've made out like a complete bandit. For the first time in 30 years, listing really matters. Not just because you've a business with less debt as a starting point for 10, but you own a business where you can acquire assets from the receiver and make disproportionate return. That's not been there for 30 years. So for the first time, I would say, don't worry so much about all the excitement about what's happened in the past in highly leveraged. Go for low leverage. Go for continuity, but most particularly keep your eyes open and get ready, because there's an opportunity to buy assets from the receiver. Keep those teams together, keep employment, and get the full return out of it for a low entry price. Specifically, I would really emphasise that actually the advantage of being listed isn't just that you actually start up with less debt, but if you're a small company, say if you were looking at the company Made.com I talked about earlier, if you're a £700 million company, you might be able to acquire something for 30 million without raising external capital. But if you're a £70 million company, you probably going to need to raise 30 million quid of money. But the bottom line is, you've got external capital, you've got the institutional opportunity, and you won't be adding 4 or 5% to earnings if you buy it for 30 million, worth 300 million for a £70 million company. You add disproportionate return. So for the first time for 30 years, it's advantageous to be listed, it's advantageous to be cash compounding and a strong balance sheet, and most particularly, it's advantageous to be a small cap, a micro cap for the first time in 30 years. All of those things are going to come together with not just the UK outperforming, but the smaller end of the market outperforming even the UK mainstream market. For the first time in 30 years, I'm saying to my clients, hopefully we'll continue to add value relative to the mainstream index. But actually, because the UK outperforms and because small caps are outperforming, we'll probably add value versus most of your international strategies as well. That's why I'm most bullish I have been for the last 30 years.
An exciting time, Gervais, particularly for the strategy that you focus on. Thank you so much for coming back in and spending some time with us. We're looking forward to seeing how the year pans out for you. Welcome back to Vantage.
Thank you very much, Neil. It's been a real pleasure.
Thank you.